Here. Good morning, everyone. My name is Stan Bradshaw, and I'm the 2020 chairman of the Richardson Chamber of Commerce, and I'm going to be the moderator today for this presentation with a panel to discuss maintaining your wealth during COVID-19, which is going to be a pretty interesting topic. So I'd like to start by introducing our three panelists today. First is Hank Mulvihill. Sorry, Hank. Hank holds two different interesting certifications: certified financial planner and a certified wealth strategist. He's a licensed investment advisor and a licensed life, health, disability, and long-term care insurance agent since 1987. He's a longtime observer of markets and global macroeconomic trends and founded a seminar series called Fed Friday, discuss the actions and the impact of the U.S. Federal Reserve. Hank's been recognized in multiple years by the 5-Star Wealth Manager Award, and he's been interviewed on CNBC Live and quoted in many other media events. Hank's firm is Smith Anglin Wealth Management, and they're a leading wealth management firm based here in Dallas, Texas. Welcome to Hank.
Glad to be here.
Our next presenter is Adam Keller, and Adam is an advisor with Atlas Wealth Advisors. He has a BBA in international business and a minor in Spanish from University of Texas in Austin. And when he completed graduation, he went overseas and was working on creating investment guides in some developing countries, highlighting foreign direct investment and some joint venture opportunities in Turkey, Romania, and Azerbaijan. So he'd be one of the few people that any of us know who's been to Azerbaijan. In January of 2005, he started his career in financial planning, earned his certified financial planner and his accredited estate planner designations. Has two partners in the firm, Atlas Wealth Advisors, Philip and David, and the three of them, this is a fun fact, the three of them completed the world's toughest canoe race, which is called the Texas Water Safari. And he's also hiked a number of Colorado's 14ers. For those of you who are not backpackers, a 14er is a mountain that is 14,000 feet or higher. And then lastly, our last speaker is John Garvey Jr., and John's a managing shareholder of Bland Garvey, CPAs and wealth advisors. He's a certified public accountant and a personal financial specialist and prior member of the AICPA Investment Committee. Bland Garvey is a firm that works with small businesses and individuals taking care of their accounting, tax, and investment needs. And so we have a CPA online here to keep our investment speakers honest and to talk to us a little bit more about the tax implications. So to get things started, this is just going to be a roundtable discussion. I have several questions prepared that I want to present the panelists with, but I think I'll just try Adam first and ask you a general question. Adam, with coronavirus severely impacting our lives and our businesses, and certainly the markets have taken a downturn, what should people be thinking about?
You know, I think thinking about your long-term plans and your plans in general is the first place in which to start. I think the markets are always going to be tumultuous. They're going to be volatile, more so recently than maybe historically. But I think the key always comes back to understanding what your goals are, what your timeframes are to those goals, and strategizing for the short term and the long term. So if you've got an adequate cash cushion and you have money to deploy, it's a great time to be opportunistic. If you've got lower income, a loss in income, then maybe you want to maintain that cash cushion a little bit longer and stronger to see what happens in the second and third quarter as well.
Hank, what do you think about that? What should people be? This is just a really broad question before we get into anything specific. What should people really be thinking about right now?
If you can't afford the risk, don't take it. I think that has been called into abundant focus ever since February 19th. If you are uncomfortable, don't do it. I mean, it's really something. I tell folks who go into the equity markets, if you can't be willing to wake up the next morning down 15%, you shouldn't go into them. Over time, they outperform everything else except for leveraged real estate. But when you get a crash like this, and this is my 5th major crash since 1987, and that was a great way to come into the business, by the way. Anyway, yeah, down 36% in 6 weeks. Give that a go. Anyhow, they do come back. Policy changes, and it has abundantly changed this time. And I'm going to say, who would short this market? You've got an 800-pound bazooka aimed at your head, known as the Federal Reserve, that has gone on record as saying unlimited support. So I want that to color the conversation as well.
Yeah, there's a lot to think about right now, and I'm hearing the same thing from you. I presume that you and within your firm have been helping a lot of your business clients with some of the stimulus relief packages. What are business owners? What are you telling business owners that are going through this?
Well, I think it's sort of like what Adam said for the individuals. It's really evaluating your liquidity. How much liquidity do you have? What credit facilities do you have? Do you have a line of credit? How much line of credit is available? Have you taken advantage of all these things that the government has thrown at our disposal to help us get through these periods, whether it's the Paycheck Protection Program loans, whether it's the payroll tax deferral, whether it's the SBA EIDL loans? All those things are there to help. There's also been some relief in required minimum distributions and everything. So there's been a lot thrown at us. The one thing I would say is every business owner is kind of reevaluating. Every business owner and every individual should be reevaluating their ability, willingness, and need to take risk. And what we've found is a lot of times when times are going well, people's willingness to take risk overrides their need and their ability to take risk. And so now is a perfect time to go back and reevaluate that, because the risk has showed up. And how did you react to it? And get a plan in place to make sure you react well the next time this happens, because there's going to be another severe bear market after this recovery happens. So I think it's really a great time to reevaluate risk, and then make sure you're talking to your advisors, whether it's your lawyer, your investment advisor, your CPA, and make sure you're aware of all these stimulus programs that are available for small business owners.
You know, let me ask you a follow-up here. I hear you mention for a business owner, line of credit. And I wonder about that, because I hear that in other places too. Do you think it's the right answer for every business owner to just take on more debt?
No, I mean, I think there's a difference between having a line of credit and using it as it's intended to be used for short-term liquidity and cash flow needs versus drawing down a line of credit and turning it into permanent long-term financing. You need to be sure that you are using it appropriately. So, we have the view that this will pass. This crisis will pass, that capitalism will prevail and will return to some new normal in the future. And a line of credit could be useful if it's used properly, but now's a really good time to reevaluate debt in general. And what we have found is there's a direct correlation with our clients to their reaction to this crisis and the amount of cash they had on hand and the amount of debt they were carrying going into this. And you got to take all those things into consideration.
Yeah, really good points. Hank, let me turn to you. It's this has been a bit of a cold shower in the stock market. Have we hit the bottom? Where do you think this is going?
Disclaimer, this is a public broadcast.
Thank you. I should have done that for all of you in advance.
Feel free to look at the disclaimer on the website, okay? So we're protected. We are protected in that this is a public broadcast. Anyway, don't go on anything I say here. Always do your own due diligence, so forth and so on. I think the bottom is abundantly in. Sure, we can trade down lower and will inevitably. Markets don't go straight up. And I don't mind saying that I think the bottom is abundantly in down there, wherever it was, S&P 2170 or something like that. And here we are breaking over some serious technical levels on the upside with momentum, power, increasing volume. So you're asking me where I think it's going to go. The stock market is the greatest economic forecasting tool that's ever been invented. And it doesn't look like it's particularly frightened by the next 6 to 9 months that it's looking at. So I think that if you haven't put some money in, it might be an opportune time to consider that. Do I think that earnings are going to be spectacular? No, I think they're going to be horrific. But guess what happens during crisis times? All that stuff that's been hidden in the income statement and the balance sheet, the goodwill they shouldn't have taken on, John, you'll vouch for this. Companies float this stuff up because no one's going to give them a haircut. Furthermore, in the public markets, the SEC has said you don't even have to issue guidance anymore. And I hope that stays in place because I think a 90-day guidance is ridiculous and people should manage longer term than that. So I think things are looking pretty good.
So Adam, how about you? The question that's on many people's minds for their investments, is this the bottom? Is it time to buy? What do you think?
You know, my crystal ball is broken. I tend to echo Hank's sentiment. I think we saw a 35% dip on the S&P from its peak in February. It's come up pretty dramatically since then. It's only off about 13% up from its peak. I would imagine we'll come back down and we may not exactly retest lows. Then again, we might. So I think, like Hank said, the key is don't look for the exact market bottom to get in. If you have cash, you've done contingency planning, you previously rebalanced the portfolio. Some of your bonds, if you hold long-term governments, are up ridiculous amounts this year. There's probably a great rebalancing opportunity. And don't do it all in one fell swoop. The same way that you would typically dollar cost average into the market, start putting some of that cash on the sidelines to work. And I would expect that as more companies' earnings come out and earnings go down over the next few quarters, we might see some prices come down in alignment with that. If it's a risk-off play and risk-on doesn't come back in favor, then prices should ride down a little bit with earnings and present some more opportunities. But man, we've seen a really big run-up, so don't miss it all. Keep some cash back for potential shortages that may come up in the future, but by all means, be looking for some opportunities to enter.
Yeah, that seems to be a common theme. Let me tell all of our attendees, if you have a question for any of our panelists, you can simply go to the chat section and post your question, and I'll be able to see them here, and we'll try to get those to our attendees. John, let me ask you a little bit about the tax side. That sharp decline here, some government stimulus checks received by individuals, and also different kinds of stimulus for business. What's unique tax opportunities and tax guidance it could be out there for people?
Well, I think one, with the PPP loans, you need to make sure you're really following the 8-week rule and getting that spent on the qualified expenses and following the 75% rule that at least 75% has to be used on payroll expenses, and make sure you're budgeting those expenses during that 8-week period really closely. But as it relates really on the investment side, there's a couple of things you can do. We're big advocates of tax loss harvesting. So in your taxable accounts, if you have an investment, a fund, an ETF that's down in value, we're advocates of capturing that tax loss, reinvesting in something similar but different, avoiding the IRS wash sale rule, which means you can't reinvest in an identical security within a 31-day period. That's harder to do if you own a few individual stocks, but if you invest primarily in funds and ETFs, that's a pretty easy thing to do. Now would be a great time to consider converting a traditional IRA to a Roth IRA. If you're going to have if your income is going to be down, you're in a lower tax bracket, and the value of your IRA, so the dollars and the gain there that would be taxed on the conversion, is lower than it would have been in prior years. That's a great thing to take advantage of. And also be aware that if you're someone that has to take required minimum distributions from your qualified accounts like your IRA, those were suspended for this year. And if you've already taken one and you're still within 60 days of having taken that distribution, you have an opportunity to undo that RMD and put it back in your in your account and avoid that tax obligation this year. But if you're in a really low tax bracket this year, it might still be the right choice to take it this year. You need to make sure you understand what's the tax benefit of taking it or not taking it. So those are a couple of things that I think are a great thing to look at. There's also a few things with COVID related distributions from retirement accounts. So if you or someone in a dependent in your house has been diagnosed with it, or you've suffered economic loss due to COVID-19, there are some more favorable rules related to loans from 401k accounts and distributions from IRAs, where you can actually spread the tax from the distribution over a 3-year period of time. But I would caution you, make sure you're making a good long-term decision. If you can leave those funds in your IRA and invested for your long-term retirement, that's usually going to be the better choice. But they've given us this unique opportunity to take an IRA distribution, a COVID distribution, and spread the tax over a 3-year period of time. And you have the opportunity to repay that distribution and undo it over a 3-year period of time, and getting tax paid in the prior year, in the years that you had done that in that 3-year window, recover any tax that was paid on that distribution. So those things are all out there, but I would caution you about IRA distributions and loans from 401ks. That's kind of a last resort option in my mind in most cases.
Well, okay, so speaking of cash flow,
I think Hank wanted to chime in on that.
John, perfect points. Agree with all of them. Treasury issued some guidance along with SBA just last week about when the 8-week clock starts. The first set of rules said it was for May and June. That's not true. It's right when the first dollar hits the account of the borrower.
Correct.
Yeah, and a lot of people are going to get caught by that if they don't pay attention.
They are.
Yes, I think I can tell you from personal experience, there's going to be some further guidance on interpretation of the forgiveness rules. And for most people who've received these funds, they're going to get that guidance after the period in which they're being measured has already begun.
Correct.
And we can only hope that there's not advice in the guidance that would have caused you to make a different decision back on the day that you got the money in the first place.
Right.
Time will tell.
Yeah, the other day that the American Institute of CPAs sent a letter to the Treasury Department, the SBA, the leadership in the House and the Senate, listing 125 items that need to be clarified in all these different stimulus bills that have been passed along the way. There's a lot of ambiguity in these rules, and we need a lot more clarification. We need it soon.
So yeah, John, I have lots of banker friends who have been processing these loans for their clients, but I also hear from all the CPA firms that their clients, the businesses, have turned to their CPAs to help them prepare the documentation necessary to apply.
Correct.
So Hank, let me turn to you. For people who invest for cash flow, for current income, what should they be thinking about today? Any adjustments that you would suggest?
It's going to be difficult to meet the targets that you had earlier this year, investing in government bonds, for instance. Would I sell them? Probably not. But would I look at 0.5% on the 10-year U.S. Treasury as something that's going to get me to my retirement goals? That might be tough. And it's going to drive everybody back into the same situation that we were after the 2008 crash, when the Fed took rates to zero the last time. And that is, people are going to go seek yield. And never forget this, more money has been lost chasing yield than has ever been lost in the equity market. So be really careful. I like high quality dividend stocks, and I like preferred stocks for that reason, but you need to look at the underlying support for those dividends. Companies are cutting and stopping dividends outright. So know what you're buying. This may be difficult to buy general funds. On the other hand, it may buffer your risk. So find somebody who does the work. There are several of the dividend funds that maintain quarterly updates relative to the quality of their constituents. And I would lean that direction. So I think it's going to be difficult to meet prior income cash flows from fixed income traditional investing, just as it was after '08.
I know you're a real student of the Fed, and have been so for a long, long time. In any other insights of what you're seeing from Fed activity that gives us a little bit of a look under the curtain about what to expect in the future?
Yes, definitely. Let's start with the bond market support, which has absolutely been stunning. For the first time ever, they're entering what are euphemistically referred to as high yield bonds. And the Fed is purchasing these directly through a Treasury sponsored facility. And those are junk bonds, by the way. And they're going down quite a long way down the risk rating ladder and buying these from issuers all over the world. The issuance over the last 3 or 4 weeks has been, of course, world record setting, because companies are saying, are you kidding? Here's a guaranteed buyer. Yes, they're refinancing, to John's point, and freeing up pieces of their balance sheets. And the Fed is going to take all this paper and they'll eventually write it off. Meanwhile, the companies get better overall balance sheet structure. So that's an insight. Cities and counties are being supported. That's been dropped down to cities greater than $250,000 are getting direct purchase of their bond issuance from the Fed. And folks, I have to just issue the standard disclaimer here. The Fed is a unique and totally unusual organization that has the absolute supernatural power to create money from nothing. It's not borrowing it from the future. We're not all going deeply into debt because of I'm not kidding here, $2.3 trillion that have been created in the last 7 weeks. But they've been created out of nothing. But guess what? They spend perfectly well, just like the dollars in our bank accounts. And when those are pumped into the economy, a great portion of that money flows to the trading desks and ends up in the equities market. Just does. So another reason that I think that some of the equities with good, stronger balance sheets are a place to go. Actions of the Fed. I just mentioned the $2.3 billion in the last 7 weeks. There's more coming, and a lot more. They've declared unlimited. They never did that before, ever. They never bought corporate bonds before, ever. And they've never directly purchased city and state bonds, although they have sponsored that market before. And to think that they'll ever run out of ammunition is just ridiculous. I hate to beat this horse too hard, but did anybody know that 60% of the reserves of every other country's central bank are US dollars? It's a mind-boggling statistic. The demand for dollars in periods of crisis is incredible. And the result of this one is that the dollar hegemony system just got entrenched for another generation. So forget the Chinese and Russian Asian infrastructure bank. Forget Bitcoin. Forget all the other rival ideas to the dollar. The dollar just got a lot more powerful. So there you are.
Fascinating. So Adam, let me ask you a similar question about cash flow. I tend to think of investments and investors, and I'm not an investment advisor like you guys are, but I tend to think of those who want to invest for long-term growth and those who want to invest for income. It's just two very general buckets. But for those who invest for income, Adam, what are you telling them today?
Yeah, I think income's been a really interesting arena since 2008. Like Hank mentioned, rates have been at historic lows. We've seen a little bit of a regression to the mean and then coming right back down to historical all-time lows. And so we've been looking at alternative spaces for some of that income, whether it's real estate, whether it's a business development company, whether it's convertible bonds or preferreds, like Hank mentioned as well. But I think there's an old adage that's great, and that's income is not equal to outcome. And so I think where we traditionally maybe wanted to stratify or segment investments between income and between growth, those things are not mutually exclusive. And maybe sometimes you're better off investing in assets that have a better potential for long-term growth, harvesting gains from those on an annual, quarterly, monthly basis, whatever your cash flow needs require, and utilizing some of that appreciation to generate your retirement income or the income on which you need to live. I think another opportunity that exists, I think John and Hank both underscored this, is the idea of just restructuring your own personal debt. Like Hank mentioned, companies are issuing bonds at pretty high rates, pretty high levels right now. And a lot of them aren't necessarily increasing the amount of debt, but they're lengthening the maturities at these really low rates. As a matter of fact, some of the rates at which they're issuing bonds today are higher than what they were at the beginning of the year. And so, again, they're looking strategically at a long-term picture. And I think we could do the same in our own portfolios. If you still have a mortgage remaining, you could potentially extend out the term of your mortgage a little bit, refinance it at a potentially lower rate, sometimes with no closing costs. Mortgages are bonds. And so if you reach out to your lender and you let them know, what can I do in the way of refinancing my mortgage rate, and I don't want to pay any closing costs and add to my debt, I think you'll find some pretty attractive options. I did this with my own lender earlier this week, and I'm at a 3.99% rate. And he told me he could easily draw me to a 3.75 and pay me $165 to do the refinance. And that was without fully solidifying the rate. So it could potentially be lower than that. Cash flow positive to me and nothing out of pocket. So I think that's part of it. Just remembering that income doesn't equal outcome. And there's other ways to derive income in a portfolio than just a stated coupon or a dividend rate. So be creative and let's work on what the economic environment gives us.
Yeah, that's really good advice. And I'll turn to John. That was really my next line of questioning. And for individual clients, is this a time to refinance things? I think many individuals have got mortgage debt and car loans. Are there any opportunities out there? What do you think?
Well, I think looking at an opportunity to refinance is a great idea. What we've seen a lot of our clients do is they had excess cash and they've opted to pay off debt instead of investing more into the market. We've actually been surprised at how much debt has been paid down during this crisis because they just wanted to get to that level of what lets me sleep well at night type of decision. Because we think most clients have a broad range of decisions they can make as far as how much debt do they carry, what's their asset allocation, all these things. But it ultimately comes down to what lets them sleep well at night is the right decision within the possible, good outcomes there. And so we've actually seen more people paying off debt than we really expected, but we are encouraging everyone to try and refinance your debt. Look at that as an opportunity. Be careful, again, always be careful about taking on more debt if you don't have to, but if you can refinance and you can save some money and you can give yourself some flexibility in your cash flow, that's absolutely a good thing to do.
Absolutely. Hank, let me go back to you. That it seems to me as just a business guy observing what's going on that not all businesses are equal and not all sectors are equal. Some people some sectors, retail, for example, are really getting hit hard right now. When you tell a retail operation that you have to close your store for 2 or 3 months, and brick and mortar stores compete with online already, they've made it even tougher. And I could name others, but I want to hear your opinion. Are there some opportunities in certain sectors that could come out of this a little stronger than others? And are there some to avoid?
There have been a lot of winners on the entire online servicing world, and there are some usual suspects out there. There are several that people aren't catching on to, and they are anybody that associates what we're doing right now. The provider of this platform has enjoyed a nice inflow. And so look to that. I don't think that these trends are going to go away. I think that these communication tools and delivery tools and other things that we've all found we can do without going to the office, a lot of these are going to become entrenched in the way we all do business going forward. So yes, I think that is something to add to the bucket for consideration. It's easy to find the winners. It's not hard to screen for them. And most of us are using them anyway. Some areas that look particularly daunting, and I think that commercial real estate is going to have some trouble. But if you go to an extreme situation, those are beautiful buildings. They'll get repurposed. And one of the great things about the United States is you can write things off and start all over again. So it's not going to be a disaster. There are so many institutional support programs in place. But I'd be a little nervous about that area. And so it's going to be a while. if I had unlimited money, I would consider doing some contrarian investing in beautiful vacation destinations. I would consider that, given that most of those locations are absolutely inaccessible currently. But people are going to go back to them. So I'm just saying that. I'm not telling you to go out and put your IRA into, you hear what I'm saying.
Sure. Adam, same question for you. That there's kind of an unequal impact of this economic event that we're experiencing right now in different sectors of the economy. What are some of the ones that you think are going to be the hardest hit, and perhaps those to avoid, and who's going to recover more quickly?
No, that's a great question. And I think if you just look at the markets as a whole, I think you'll see the bigger companies that have access to the capital markets and the ability to issue new bonds and rely on that Fed backstop. I think we'll see them recover more quickly, because while they may have a reduction in revenue, their cost cutting that they're implementing right now, I think, is also offsetting that to maintain some degree of their margins. I think it's going to be a lot harder on the small business. And so we may qualify for a PPP loan or an SBA loan, but they may not be an equally as ready to supply and or as accessible to some of the smaller businesses like restaurants. So I think those guys are going to be in a pinch. And I think there's going to be a lot of those small businesses that may potentially not come back. I think it's that rule of thumb that says 80% of small businesses fail. There's a lot that operate on very low cash cushions. And so when you take a month to 2 months worth of revenue out of their picture, that makes it very hard to sustain their business. So I think maybe we as business owners and individuals in the North Texas area kind of keep an eye out for those guys and girls and see what we can do to help, whether it's going and supporting and buying a meal or whatever it may be, to be a patron of the places that you really like. I think an opportunity that will also exist out there is in the automotive sector. I think there may be folks that will delay and postpone the purchase of a new vehicle. And so I think as that happens and those sales really come to a halt on the automotive side, you may see some really good deals. We've already started to see GM and some other big manufacturers offer 0% again, that had started to go away at the end of last year. So I think that'll come back in, whether it's refinancing existing auto loans or finding really good deals on new purchases. And maybe if you're owning a business where you've got a fleet of vehicles that are becoming obsolete, and maybe John's helped you fully write off the value, there's no more depreciation allowed in that, could be a good time to go and reinvest in some capital assets that you could get at a discount, especially maybe the middle of the year, third quarter, when we've seen a number of months of COVID-related revenue drops reflected in earnings, et cetera, and give a little bit more impetus to companies to potentially sell at discounts. So that's my story, and I'm sticking to it.
John, I think in the stimulus package there were some subtle tax changes. You mentioned one or two things earlier, but there might be some others. Are there things that businesses should be thinking about with this new stimulus and some tax provisions? Anything special out there we should know about?
Absolutely. One of the biggest provisions that we hear very few people talking about is a revision to the net operating loss carryback rules. The rule had been changed in recent years where you were basically carrying forward those losses. You can now carry back those losses for 2018, 2019, and 2020. Those losses, if you incur, you can go back 5 years and amend tax returns and recoup tax paid in prior years. That's a huge benefit. One of the things that potentially is going to happen with these PPP loans is they're going to generate a lot of losses, because you're going to have, the way the law is written right now, you have the potential to have the loan proceeds forgiven as a grant. But there's nothing in the law yet that has said you do not get to take an ordinary deduction for the expenses you pay with those PPP loan proceeds. And so with revenues down, and then also getting the expense side of the PPP loans, there's a potential for some pretty significant losses. And even if you had a loss carry forward in 2019 into 2020, you can go back and amend 2019 and carry that back and recoup losses and tax paid in prior years. So that is a huge windfall for small business owners. Obviously, with the issue of taking losses in the current year because of the PPP expenses, there's all sorts of issues if you have a partnership, an LLC, an S Corp. There's all sorts of issues about basis and how much loss can you take in excess of a basis. Those are details you definitely have to look at. But I think the net operating loss is a huge benefit for a small business owner that is just not getting much press right now. And we don't understand why. We're spending a lot of time going back and looking at those opportunities to carry those losses back. And I think every small business owner should call their CPA and say, hey, how does this apply to me? Because it would be a travesty if that benefit was missed.
So if I'm understanding this correctly, and I think I do, if you had a loss, even from an investment, if you have a K1 that attributed to you had a loss in 18 or 19 or one that would occur this year, you can take that loss and go back to your 2017 or 2016 tax return and refile that, claiming the loss, and get a refund of taxes you paid years ago.
If that's a loss from a trade or business. If it's just if it's an investment gain or investment loss that float like a long-term loss that flows through on a K1 from just an investment transaction, that's not necessarily the case. But if it's from a trade or business, a loss from a trade or business, then you have that opportunity. Excellent.
So Hank, I'm gonna read a comment from one of our viewers and get your reaction and your thoughts on this. The consumer price inflation is not on anyone's radar as a problem. In fact, deflation is a bigger risk. However, if inflation becomes a problem and the Fed's required to tighten or reduce the size of its balance sheet, it's a huge problem for stocks and bonds. What are your thoughts on that?
It can be. The scale is larger now, but in the past, shockingly, and I think I still have a chart out there on one of my websites, but in prior tightening cycles, and again, this is pretty much pre-08, so the rules are different, I guess, today. But weirdly enough, when they started the tightening cycles, that meant the economy was getting better, and stocks would rise right along with that for a while. And often that a while could be 3 months to 3 years. And I did the work back then, and you can find it if you want to plot the S&P against the Fed tightening cycle. Back then, these were quarter-point increments. Sounds like a lot now. So do I think CPI? Let's get to that. After all these crises, the Congress, the president come together on the fiscal side. The Fed does what it does on the monetary side. And the goal is to fill the great gap that's been created by whatever the disaster du jour is. So the crude analogy is they're going to keep shoveling dirt until they fill the hole. And I like that analogy. And if they overfill it, then you've got inflation. All right? It's simplistic, but it's fairly true. If they put too much money into the system, you will see inflation. And we'll know what to do. They do have techniques for reducing the amount of money in the world. They're very good at that. And they were very much engaged in that until basically the end of February of this year. Mm-hmm. So yes, I think that they know what to do.
So what does that mean to the average investor? Should they be concerned about inflation?
I would say at this time, no. And there are a lot of inflation surveys that are published, and they're published weekly actually. So it's not hard to figure out if you start getting an uptick. And it's going to be very difficult to depend on the bond market to tell you currently the way it used to. The bond market is a fabulous forecasting tool for inflation, but it's being artificially supported or yield suppressed, bonds being bought. So it's going to be hard to tell. But you'll be able to see it. There are several surveys, not just the CPI. There are several of them out there. There are some broad surveys about the grocery basket cost, for instance. What do things really cost people on the street? And you can see what rents are doing, things like that. When those start to trend upward, yes, you've got some inflation. And then the Fed will take action. They watch those things as well.
So one of the things that I've noticed, and I guess I get this from my interaction with officials at the city of Richardson, with the closure of business for what's going to amount to 2 months, and we hope not more, but the cities across the country depend upon property taxes and sales taxes predominantly for their revenue. This is a big hit to sales tax. So it's going to be a big hit to a city budget. I will stick with you again, Hank. What does this mean to municipal bonds and to the whole debt market for counties and cities?
It throws that market into enormous disarray. And thank goodness the Fed recognized that. I believe that they will lower this 250,000 population measurement to smaller cities such as Richardson, whatever we are now, about 120, I think, 120,000 people. I think they'll lower it to smaller cities. I think they'll have to. And otherwise, those cities are going to be in serious distress. You've got hotel motel tax. Don't forget that. That's a big deal. And all the other things that you've mentioned. And cities are going to take already have taken significant revenue hits. Those are not easily monetized away in the municipal world. You can't do that. You're going to go to your rainy day fund, your reserves. You're going to issue debt if you can. And the Fed has made that window more open than it would have been, because no doubt current cash flows of municipalities all over the United States are severely impacted. Probably the most distressed are going to be your rural hospitals and the debt that's issued there. Outside of New York City, this is something people aren't talking about at all. Remember, all the beds had to be free all over the United States for COVID. Well, guess what? Most healthcare professionals have been laid off, furloughed, or taken a pay cut all over the United States. What do you think that does to the revenue of the hospital systems? And there are a lot of bonds out there that are based on those. And those are going to be very interesting, quasi-municipal, quasi-corporate. And that's going to be a tough sector.
So it sounds like picking the right bonds, if you're a bond investor for the near term here, is going to be a pretty challenging process to know which ones to pick and which ones to avoid.
No doubt about it. And here, it might make sense to hire professional managers, seriously. In the bond market, it's always been very opaque and difficult to ascertain. And now it's all backward data anyway. So you might want to be really careful about what was formerly a AA bond may not be anymore.
Right. Adam, we talked about sectors a little more, but let me challenge you with a really tough one. This is Texas. And simultaneously with coronavirus, we've watched the price of oil go. Goodness, a week or two ago, they were paying people to take oil, if I understood the contracts correctly, a negative price for oil. And now we're still hovering in the teens, way below what any layperson knows. It costs more than that to get the oil out of the ground.
Right.
So let's talk about energy. What are your thoughts on energy?
Yeah, that's a great question. And, I think I'm going to actually tie that back as well to Jeff's question on the group chat on inflation. Commodities are typically great inflation hedges, and commodities consequently are the only asset class over the last 15 years that have a negative return. And so I think not just energy, but a basket of commodities as a whole has been pretty beaten up as an asset class the last 15 years. Stand on that, it's a supply issue in a lot of ways, right? And what's economic to drill in one area from an oil perspective, it's not in another. I guess the economic price point for shale has been around 45, and that's coming down. But you look at producers like Saudi and Russia, and some of their drilling is economic at $12 a barrel. And so there's huge discrepancy between those metrics worldwide. And so I almost equate it to the idea of really big companies and really good times going and overhiring and having way more workforce maybe than they need. And you seeing a drastic cut in the workforce when times shift and we go into recessionary times. And so I think we'll see that rig count, number of producing wells, all those things will be drastically slashed to the point where, hopefully that will start to curtail supply to some degree. That'll allow price per barrel to come back up. But as to when, who knows? So I think Hank earlier mentioned if he had all the money in the world that can make a contrarian play, I think I'd also be looking into a little bit on the commodity side from a contrarian investment and say, look, who knows, with alternative energies and natural gas and whatnot, oil may be depressed for a while, but it's hard to imagine that it's going to stay that low for that long. So, Stan, I think we'll see consolidation in the industry. I think we see this a lot. You get a lot of small players that get into the oil and gas exploration side, and they may go after 1, 2, or 5 wells, and they may lose everything in this process. But then you have the big Exxons and Chevrons, et cetera, that can come in with really steep balance sheets. I think Exxon's sitting on like $3 billion in cash. They can come in and scoop up some of these assets at fire sale prices and be much better on the back end of the recovery. So I would expect to see some consolidation. If we do get inflation, that'll help. If there's a weakening of the dollar, obviously the price per barrel, et cetera, goes back up as well. So it's just kind of a good economic hedge in my mind. And I don't know if that answers your question, but hopefully that provides a little bit of insight.
Well, yeah, oil's a really tough one. Let me ask you one more before we move on. I think about the reaction to this downturn and how it's affecting business. And we have these PPP loans and we have the economic disaster loans and the things to help business, but these things are going to run out. And I don't think anyone believes that business in July will be back to what it was in January. It's just, there's very little chance of that. What impact is this going to have for the remainder of this year on our banking system? A lot of these companies that are struggling and won't make it have bank loans. What is bank and finance a place to invest, or do we have trouble ahead?
You know, I think that's a great question. I think banks have been pretty resilient and are in better positions than they are today than they were in the last downturn. And a lot of that is the FDIC imposed balance sheet measures, et cetera. I think banks have been smarter on loan to value ratios too. So if you think about that and just equate it to real estate, and you have a $100,000 piece of property, but the bank limited loan to value at 80K at 20% equity requirement there, they can allow that investment to ride down 20% and still sell it at a discount to market value and recoup the full amount of their loan. So I think they've been smarter on loan to value ratios. There may be some secondary lenders in the mezzanine space that take a bath. And I think, again, some of those businesses, unfortunately, are going to fail. But I have a lot of optimism in the resilience of Americans and entrepreneurs in general to say that sometimes businesses fail, and that's a risk we all take. And I think we, as the community around them, hopefully can help them on a personal standpoint. Hopefully we learn a little bit from the lessons of failures and have a more robust economy on the back end.
So John, in your firm, I know you advise clients in a wide variety of industries. I'm curious from a non-investment advisor's perspective, but more of a business counselor. I think that's probably more where you are on the tax and CPA side. What are you seeing from businesses that you think might be more at risk and those that might have a little bit better chance of coming out of this looking okay?
Well, I think the hospitality industry is going to have really significant challenges for some time with our governor's order of, restaurants will be able to open soon with 25% capacity. Some of our restaurant clients are telling us at 25% capacity, it doesn't make any sense to open the doors. Even at 50%, it may not make any sense to open the doors. Those businesses tend to have less working capital, less liquidity. So the hospitality industry is going to struggle for, I think, quite some time, especially in the restaurants. And I think that's the place where you're going to see a lot of them just, unfortunately, are probably going to fail. But we're in a society that sure doesn't like to cook at home. We like instant gratification. And I think you're going to see new startups, new people filling their shoes in a short order of time. But I think that's going to hurt for a while. And I think the oil and gas industry and real estate are going to hurt for a while. I think, I hear all of our clients are saying, this working from home thing worked better than we anticipated. We're actually more productive than we thought we would be. maybe I don't need as much office space as I used to. So I think commercial real estate is certainly something that's going to be perhaps struggling for a while. But there's also an opportunity there for people whose leases are about to come up for renewal. There might be an opportunity to get a better deal than you had before. So with every bad thing that's going to happen, there's potentially an opportunity for someone else. And then I would go back to this oil and gas. I think that some people said this is the end for the oil and gas industry because the alternative fuel sources and energy sources have been coming along. But one of the things that's happened now is the price of oil is going to be so low and fossil fuels are going to be so cheap. The economic incentive to use alternative investment or alternative energy, is not going to be there for a while. There might be the incentive from the green energy perspective, but from an economic incentive, the cost of fossil fuels and staying on that energy path just got cheaper for a considerably longer period of time. So I think those oil producers that can stay in business, that can ride this out, still have long-term opportunity there, but I think they're going to have short-term struggles. So I think those investors that have cash, whether it be private equity or individuals that want to buy a small business, I think there's going to be a lot of good opportunities out there. And so I would just encourage people to, if you're going to be an equity investor, you have to be somewhat optimistic about the future. Otherwise, you'll drive yourself insane and you shouldn't be invested in the equity markets, right? But if you're a good business owner, you've got to be willing to take that risk. And when that risk shows up, it creates an opportunity for somebody else and some other investor, some other competitor in the marketplace. And I think that's what we're going to see. And unfortunately, the small businesses may get hit more here for a while, but I think there's always going to be a place for small business owners. There's a lot of people like me. I'd make the world's worst employee at this point in time in my career. I want to stay in a small business and independent. I think there's just a lot of people that are like-minded like me, but I think they're going to have a tough go for the remainder of this year and maybe into next year.
So Hank, I know you had something you wanted to say, and I want to stick with this sort of oil and gas theme, the low cost of energy. It's certainly going to create some problems for some companies, but it creates opportunities for others. What are your thoughts? From everything that I see, it looks like low prices for energy are here for a while. What are your thoughts on this?
I completely agree, no doubt about it. The chief beneficiaries are going to be transportation, obviously, and residential costs maybe, because that's regulated and highly unlikely to be allowed to be reduced in the near future. But if you can keep pricing your own electricity use, here in Texas, we're allowed to do that. We can shop, and it's a very competitive marketplace, and there's basically no cost to switch. So it's an unusual environment we have here, but airlines will benefit if they stay in business. Trucking will benefit. So anything where the great users of petroleum will benefit, no doubt about it. Pharma uses petroleum, particularly natural gas, as a feedstock. So their costs are going to be lower. Anybody uses natural gas, cost is going to be lower if they're not locked into long-term take contracts. So yes, Dan, that will be a great benefit to everybody else who's not in the production side. I want to help add something to both of the previous conversations from Adam and John, and that is about the banks and the Fed and small businesses and loans. Forbearances have been almost universally granted. It's been amazing to watch the banks respond to this. And the forbearances are very generous. And there's a hidden reason for this. On the Sunday surprise, when the Fed finally acted, whatever that date was, 25th of March or someplace back there, when they finally showed up, that was a little bit before that, 12th, 15th, anyway, when they finally showed up with the Sunday surprise of the rate cut slash from 75 basis points to near zero, buried in that was a stunning thing that I've never seen in my life. Banks no longer need to maintain reserves. You know what the reserve requirement is right now? zero. I think that is incredible. So that capital got freed up for them to support forbearance programs, if you will. The banks were already extremely solvent and well capitalized going into this crisis, and now even more so. So I think the system has flexed a bit, and maybe it'll help some of those small business people. And that is a terrible place to be right now. No cash flow. Most of, if you depend on 3 or 4 months of sometimes summer traffic to get you through the year, that's a horrible thing. So I really do pray for a successful outcome. I don't want the invisible hand to wipe out all my business friends.
Okay, so we only have a couple of minutes left here, and I'll give each of you a shot at this. Give me one kind of investment to avoid right now and something to be looking at. And we'll start with you, Hank.
You've already heard my mantra is sound balance sheets, dividend paying companies, and continue to monitor the ability of those entities to do that. Oh, avoid leverage that can't be restructured, difficulty of maintaining revenues, and those sectors have been already discussed. So I don't want to throw anybody under the bus.
Adam, how about you? Industries to consider looking at closely for investments and things to avoid.
Yeah, we tend to be more broad market players, and so we look at that idea of kind of dollar cost averaging into the current environment. And so just look at the indices. It's fun to go look at individual companies that are trading at single digit price to earnings ratios, while the broad market is still kind of up a little bit above its historical average. But man, you're getting a great basket of goods. So I'm going to be kind of generic and paint with a broad brush and say, look at some of those broad indices or ETFs. If you're wanting to play the tech sector that's been more resilient, look at a broad tech sector ETF. And I think as far as what to avoid, yeah, anything that's highly leveraged. So if you've been playing in the high yield debt space to boost your yield in this time when yield's hard to come by, if you're looking at mortgage REITs that are 80% plus leveraged, those might be good to avoid in the short term. But yeah.
So let me ask you a couple of quick ones. Would you buy a REIT today?
I think look at the underlying metrics. Look at its funds from operation. Is it covering its current dividend? And what's its dividend payout? So a lot of times REITs will trade on income. And if its dividend payout is 100%, meaning it's paying out of 100% of its earnings to supply its dividend, I would imagine that dividend is going to drop. It's going to make it less attractive versus if something's got a 50% payout ratio and they're holding earnings back and retaining those to reinvest in their property, that might be a little bit more attractive. And I think Hank or John said it before, some of these REITs own A grade properties. They're not going anywhere. And so if you're in a position where you can hold it for a long term, hedge funds own them, you have a lot of institutional buyers for them, sure. But not all REITs are created equal. So don't go chasing a REIT based on yield if you don't know the underlying metrics.
John, real quick, I'll give you about 30 seconds.
Sure.
Something good, something bad.
I would be leery of stretching for yield, whether it's credit quality or length of maturity. I would avoid that. And then we're sort of like Adam, we're more of a broader basket of investment in our client portfolios. So, right now, if you look at what's been hit the hardest, it might be the best buy for the long term. Small cap stocks are way down a lot more than large cap stocks. Same with value and even some of the internationals. So we really look at the investing in the form of rebalancing the portfolio and really looking at what were you committed to for the long term, what's the most underweighted, and that's where we would suggest considering putting some money.
Thanks, John. We have contact information on the screen from John Garvey, Adam Keller, and Hank Mulvihill. I thank all three of you for being our panelists today. This event was put on by the Richardson Chamber of Commerce, and I want to thank Beth Coleman and Shannon Scripta at the Chamber who coordinated all this. So for all of our attendees, thank you for being here, and that's going to wrap us up for today. Thanks, gentlemen.
All right. Thank you.
All right. Bye-bye.
Bye.